Fryar Financial's Financial Behavior Podcast. Tonight, Jeffrey Campbell and I are talking Roth strategies and Roth distribution strategies. We'll be reviewing some strategies for growth as well as explaining to you all the rules and how you take your money out of the Roth IRA. So, without further ado, we will get started. All right, so we're going to begin talking about some strategies for growth. All right, so I think I went too far. So Jeff, if you can, let's first begin before we even jump into the designated Roth account. If you could just kind of give the viewers a basis for what is Roth versus traditional, the tax implications and things of that nature.
Yeah. So I think the biggest thing to understand when it comes to Roth dollars is those Roth accounts are funded with after-tax dollars. So that's after you pay taxes on those dollars. So you don't have to worry about that tax deduction in that moment. You fund it with those after-tax dollars, and then the reward from doing that is those qualified distributions are tax-free, including those earnings, which is key, which gives you a little bit more flexibility as retirement goes. So, and because those distributions aren't taxed, Roth balances generally don't count towards that taxable income either. And that also kind of helps with managing Medicare and Social Security taxation and IRMA surcharges and all that kind of stuff too, which we kind of touched on in our last session, that permanent insurance lifestyle. So that it kind of helps managing that kind of stuff too.
Sure. Now, philosophically, what are some of the kind of things we're considering as we're trying to make the decision? Do we do a traditional IRA and take a tax deduction today? Do we do a Roth and defer the tax deduction and pay the taxes on the money today? Is there a combination we should be looking at? So what is kind of the thought process between an individual looking at those different things?
Yeah, I think first we're going to start at your income level. That's the first thing we're going to look at is where you're at income level. There is a income limit for Roth IRAs, and you're looking at under an adjusted gross income, yearly income of under 150,000 to be eligible to invest in a Roth IRA. So that's the first initial key. And then it's really, you're going to weigh each option and look at the current tax state of that we're in as a country, as a state, and see what makes the most sense in that moment. And also, because it's hard to kind of plan what we're going to look like tax wise in retirement, what that tax dollars might be, or what the tax state that we will be in will be outside of your individual situation. But we weigh all those options and kind of make the best decision to see where we should put those dollars, whether it be Roth or traditional or a combination. I mean, all three of those are on the table. Anything you want to add to that, Marcus?
Yeah, yep. As he's saying, so it's the tax brackets we're trying to look at, and so today we know what tax bracket we're in. Let's say you're a high income earner, you're in the 32% bracket. Now, what we're trying to figure out is, like Jeff saying, where will we be in retirement? Will we be in the 22% bracket? Will we be in the 24% bracket? And that leads to when we should take that deduction. Thankfully, there are a lot of calculators out there where you can plug these numbers in and make some assumptions, and it'll kind of walk you through what the tax savings could be and what your capital you can grow. We've got one on our website as well that does such. So feel free to take use of those such calculators to help you decide what that looks like. And of course, we're here available too to help you through that. So now let's get into the designated Roth account and make sure you understand what the difference is between a designated Roth account, which is under an employer's plan, versus you having your own Roth account. So take that away, Jeff.
Yeah, I think the biggest thing is, like I said, that designated Roth account is under an employer plan. So that's underneath your 401k that you're funding as an employee. That's the biggest thing. And then they designate those dollars inside that 401k into Roth dollars. And there's ways that you can do different things to move that money and move more money into Roth dollars and that kind of stuff too. But I think one of the biggest differences is compared to that traditional 401k, that there is no required minimum distributions anymore. I think that came into effect as of 2024, if if I'm correct on that one. But as of now, there is no required minimum distribution. Um,
Y'all kind of jump in real quick. It was kind of
mhm.
strange
Yeah,
because it was kind of strange to even have a RMD on money
hmm
that's not going to be taxed anyway.
exactly.
I don't know why the IRS even had that, because we'd say, okay, Jeff, you got to take your money out, but I've had it in
hmm
there. It's a qualified distribution, so I'm not paying tax on it anyway. The whole purpose of RMDs is to generate some tax money for the tax revenue for the federal government.
Yeah.
So it was kind of strange that it was even on there in the first place.
hmm
Um, the other thing too, where the employer plan is nice because you do not have any income limitations to participate. So if you are a high income earner and can't traditionally go into a Roth, one step is to do it under the employer plan because there are no income limitations.
Exactly.
Which that leads us right into our next slide, which is, if you are above the income limitations, then what do we do?
hmm
So take
Yeah.
that away,
So
Jeff.
yeah, once you're in those, and we're kind of get into the funding strategies now. Um, and like you said, the problem is now that you're over those income limitations. And that's where the backdoor Roth IRA comes into play. And so because of those limits, you have people that are over those thresholds, um, and they need an opportunity to invest in Roth dollars. Now, the federal government sets these limits to kind of um, give more benefit to people under a certain amount of income, to receive those type of benefits tax wise. But they still, for our high earners, we like to find a way to get behind those limitations in this completely legit way. There's nothing wrong with doing these backdoors, even though it sounds sneaky. Um, yeah, so essentially a backdoor Roth is to make a non-deductible after-tax contribution to a traditional IRA. And like I said, let's just say you throw that whole 7,000, that limit for the year, which is the IRA contribution limit. You throw that in there, and then as soon you want to do this quick, you want to convert that straight into Roth dollars. Um, and then any gains in the interim, that's why you want to do those quick, because any gains before you convert those may become taxable. So the timing of doing that is crucial. You want to do it as quickly as possible. Um, yeah, exactly. And then the other key part of that is that we'd have to file that form 8606 to keep track of your basis. You have to do that manually as well. And that's just as you're there's different situations where you might switch custodians. For example, let's say you open up, you have an account with Fidelity, and you're doing this backdoor Roth. You have an IRA or 401k or a Roth inside the 401k with Fidelity, um, and you want to switch to Charles Schwab. That type of information of your basis could be lost in that switch. So it's important that you're keeping track of that manually, so you always have that information, no matter if the custodian loses it or not. So I think that's the biggest key of that.
Yep, absolutely. Because so to take it a step further, what he's saying is,
hmm
when it switches custodian, that second custodian doesn't always know that opening date, and that's not always sent over. So the only way to preserve that documentation is for you to do it yourself, so you don't have any problem with the IRS down the road. So
Exactly.
that form 8606 is perfect to file with your tax returns to keep that information solid. All right, next
hmm
we got the mega Roth strategy. So this is a business strategy. It can be difficult for some businesses because of the IRS testing rules. If you have a number of employees, you kind of got to get your TPA to run some illustrations to make sure it makes sense. But in essence, what you're doing is you're setting up your retirement plan to allow for after-tax contributions. So if you can imagine, a person has contributed, they've maxed out their 401k, they put in their 23.5, they have, let's say the employer has matched 6,500, so they've got $30,000 in the plan. But the IRS rules based on their income, maybe a limit allows them to put another $10,000 into the plan after tax. Or let's be aggressive and say $20,000, especially if it's the business owner. So now what happens is you make a $20,000 after-tax contribution into the plan and immediately convert it to a Roth. That's how you grow a Roth really fast because you're past those $8,000 limits. Now, this works perfect for single member businesses because when you have a solo 401k, there are no testing rules. So you can really fund a Roth without worrying about meeting those or surpassing those income limitations and those contribution limits. All right, Jeff, take away the 529 conversion. This was new as of 2024 in the Secure Act 2.0.
Yeah. And for those who don't know, a 529 plan, it's a plan that parents usually set up for the education of their children, where they're putting in dollars for that college fund essentially. So what happens sometimes is the child may not may take an alternate route or get more scholarship money or anything where now you have unused money in that 529 plan. So the Secure 2.0 Act allows us to use those unused funds in that 529 plan and convert those into Roth dollars and into a Roth IRA for that same beneficiary, that same child. So, which is important. And now, when you do that, it still is under the guidelines of those same income limits that I mentioned before. So the child has to have some form of income coming in to open up that Roth account. And then it's also important for this. So there's a lifetime limit of 35,000 per beneficiary. So that means that you can't do more than 35,000 of those unused funds, essentially. So I think that's the biggest thing.
Correct. Yep. So let's
Hmm.
just say you got 35 and the current limitations each year are $8,000. So you do 8 for 4 years
Hmm.
um, to get to 32. And then last year you do that $3,000 for that child to get all that money over to Roth. So that's pretty neat.
Yeah.
Pretty neat rule. Now let's talk about distribution strategies. How do you take your money out? So first thing, if the distribution is qualified, stop. There's no further assessment needed. The ordering rules don't apply. But if it's not qualified, then we have to apply the ordering rules, and we're going to go through those as well. All right, so qualified distribution. So remember we were saying we needed to keep track of the funding and the time. So that 5-year clock starts running. So we can't impress upon you enough. If you do not have a Roth IRA, get one started. Even if you just put $1 into it, it doesn't matter. The more important thing is to get the clock started. So first get you a Roth, get the clock started. Now, once you've reached that 5 years, you reach 59 and a half, or first time home purchase or disability or death, you can take this money out 100% tax-free, penalty-free. That is a qualified distribution, 100% tax-free and penalty-free. But let's say these conditions aren't met. Now, what do we have to do? So what is called is the ordering rules. We have to go to these ordering rules. So first you can take out your contribution, your basis, and your 529 basis first. No tax. Next, you go to conversions and rollovers. And then finally, you go to your earnings. So I've got a little bit better slide that kind of breaks this down for us. So let me switch screens a little bit. And we want to share this one here. All right, so this screen is better. So here are our different levels. So if it's these are the ordering rules. So contributions and rollover basis and 529 plans. These distributions come first. So they are tax-free and penalty-free if qualified. If it's non-qualified, these are still tax-free and penalty-free. So what you put into the plan as your basis can come out tax-free and penalty-free, whether qualified or non-qualified. Now, if it's a conversion or a rollover, again, qualified, tax-free, penalty-free. If it's non-qualified, it's tax-free, but there can be a 10% penalty if there's no exception. Finally, the earnings come out. So this is the distribution come from this source last. Again, qualified, we're tax-free, penalty-free. If it's non-qualified, both tax applies and the 10% penalty applies. So when we're taking out money, generally speaking, we want to stop at the conversion, especially if a penalty may apply. hopefully if a penalty is waived because you have an exception, you're going to be tax-free and penalty-free. We kind of want to get to the earnings last. So a lot of times we'll have a maybe someone who has inherited an IRA, and we will tell them, just don't touch the earnings, because more than likely you can get around the first two with the death, with it being a death of the account owner
Exactly.
and the contributions. And then that way we can get them some money tax-free.
Mhm.
So that's a good slide on how those work and what the penalties look like. All right, so let's finish up here. All right, so to finish up, here are our key takeaways. Jeff, I'll let you kind of take these away for us.
Yeah. So, like you just said a few minutes ago, it's important to start that Roth IRA as soon as you possibly can, even if you can only put $1 in there. Get that clock started. And like in the 401k, the Roth dollars inside of 401k, they don't start toward that clock. So remember that. Those are designated dollars, and they're a little bit separate than what's in a Roth IRA. Document everything. I think that's the biggest thing. Keep track of all your contributions, especially in that 5-year period. Like I said, because things are going to be lost when switching from custodian to custodian. Roll over Roth 401k into a Roth IRA to take the distribution from the basis. Because otherwise, that Roth 401k, the distribution is prorated from your basis and your earnings. So you could possibly take a tax impact from that if it's not managed correctly. So that's also important. And then lastly, if you're inheriting an IRA, take all the money needed up to the earnings and do not touch those earnings. I think that's one of the biggest things. We can say try to take the money you're putting in first, your contributions out first before you touch those earnings, because that's when taxes come into play. So
Awesome. Now we do have one other tip we need to share with you all. So especially with the advent of, say, and it doesn't really necessarily only apply to crypto, because if you can think of crypto, it's things that people are purchasing that has the possibility for high appreciation. So this strategy here we're going to share could really apply with anything that you think may have high appreciation. So for instance, again, back to crypto. So let's say we have our crypto in a regular taxable brokerage account, and we bought $1,000 worth of crypto, and it's now worth, I don't know, $100,000. So we've got a $99,000 gain. If we want to sell that crypto, we'd have tax on it, right?
Mm-hmm.
Now, just imagine, had we purchased that crypto inside of the Roth, we get to the qualified distributions, we can take that out tax-free. So your thinking is anything that you're going to hold for a long time, and it could be highly appreciable, put that in your Roth account, because that is another example of a mega Roth. So that's one tip, and a lot of people, they just kind of don't think about that. But then after we explain it, they say, "Oh yeah, that makes a whole lot of sense." So at any rate, that will sum up our presentation on Roth strategies. We will be back mid-October talking about estate planning, and a lot of people are really excited about that. We'll have Attorney Mariah Street on for that. So until then, let me stop my share screen. We look forward to talking with you next time. Be sure to sign up for the YouTube channel to watch us on the YouTube channel. We'll be coming out with more information. Until then, happy investing. We'll talk to you soon. Thanks.
Have a good one, everybody.